Welcome to Brand Insider. In this video, we are going to talk about future of cryptocurrencies. Cryptocurrencies have evolved from digital novelty to trillion-dollar technologies with the potential to destabilize the global financial system as only a few years. Bitcoin and dozens of other cryptocurrencies are becoming more popular as investments, and they're being used to buy everything from software to real estate to illegal substances. Cryptocurrencies, according to proponents, are a democratizing force that takes control over money generation and control away from central banks and Wall Street. Critics, on the other hand, claim that the new technology is completely unregulated, giving criminal gangs, terrorist organizations, and rogue governments more power. They argue that crypto mining, which consumes a lot of electricity, is also bad for the environment. Financial regulators are scrambling to come up with a solution. Cryptocurrencies are regulated differently around the world, with some governments welcoming them while others prohibiting or restricting their use. To fight the crypto explosion, central banks throughout the world, including the US Federal Reserve, are considering launching their digital currency. What are cryptocurrencies? Cryptocurrencies, so named because they use cryptographic principles to issue virtual currency, are often transferred between persons who have virtual wallets on decentralized computer networks. These transactions are recorded publicly on decentralized blockchains' tamper-proof ledgers. This open-source architecture prevents coin duplication and eliminates the need for a central authority to validate transactions, such as a bank. Bitcoin, the most well-known cryptocurrency, was founded in 2009 by the pseudonymous software developer Satoshi Nakamoto, and its total value has surpassed $1 trillion at times. However, a slew of others, including the second most popular, Ethereum, have sprung up in recent years and function on the same broad principles. Users of cryptocurrency send money between their digital wallet addresses. These transactions are then organized into blocks, which are subsequently verified across the network. Users benefit from a degree of anonymity because blockchains do not store real names or physical addresses, only transfers between digital wallets. Some cryptocurrencies, like Monero, claim to offer increased privacy. However, if a wallet owner's identity is discovered, their transactions can be tracked. Bitcoin miners earn Bitcoin by confirming network transactions, a procedure that requires them to solve mathematical problems by guessing and checking trillions of possible solutions using computers, a technique known as proof of work. Many cryptocurrencies employ this strategy, however, others also use proof of stake as a validation process. In the case of Bitcoin, a new Bitcoin is given every 10 minutes when a new transaction block is added to the chain. As time passes, the benefit diminishes. Although the total quantity of Bitcoin is limited to 21 million coins, this is not the case for other cryptocurrencies. Bitcoin and many other cryptocurrencies have different prices depending on global supply and demand. Some cryptocurrencies, however, have fixed values because they are backed by other assets, earning them the moniker, stablecoins. The popular stablecoins Tether and USD Coin, for example, are allegedly pegged at $1 per coin, though regulators claim this is not always the case. Why are they popular? Cryptocurrencies, notably Bitcoin, were once derided as a fad among tech advocates, but their value has surged in recent years. For the first time in 2021, the price of a Bitcoin surpassed $60,000 for the first time. Different currencies appeal to different people, but cryptocurrencies' popularity originates partly from their decentralized nature. They can be exchanged swiftly and anonymously, even across borders, without the need for a bank to block or charge a fee. For example, dissidents in authoritarian nations have solicited funds in Bitcoin to avoid governmental controls. Digital assets, according to some analysts, are essentially investment tools. Bitcoin and other cryptocurrencies' prices vary drastically, according to some experts, limiting their utility as a means of transaction. Most buyers and sellers are hesitant to accept payment in anything whose value fluctuates substantially from one day to the next. Some establishments, though, do accept Bitcoin. Many investors regard Bitcoin as a speculative asset to be held rather than used to make payments, and it is frequently compared to gold. Because the supply of Bitcoin is eternally fixed, unlike fiat currencies, which central banks can extend indefinitely, some see it as a hedge against inflation. Some experts, however, have cast doubt on this claim. Other cryptocurrencies' valuations are more difficult to explain. For example, Dogecoin was developed as a joke but has since skyrocketed in value, thanks in part to the support of several high-profile investors and entrepreneurs. What exactly is DeFi? Cryptocurrencies and blockchains have spawned a new breed of decentralized finance, DeFi, companies and projects. DeFi, which is essentially a cryptocurrency version of Wall Street, intends to provide consumers with financial services, borrowing, lending, and trading, without the need for legacy institutions like banks and brokerages, which charge high commissions and other costs. Instead, when specific criteria are satisfied, smart contracts perform transactions automatically. DeFi is gaining in popularity, with tens of billions of dollars being invested in the sector. The Ethereum blockchain is used to power the majority of DeFi apps. Blockchain technology, experts say, has a range of potential applications beyond Bitcoin because of its utility in tracking transactions, such as aiding real estate sales and international trade. What challenges has this created? Cryptocurrencies have also presented governments with a new set of issues to deal with. Cryptocurrencies appeal to bad actors such as criminal gangs, terrorist organizations, and rogue regimes because of their anonymity and portability. There are also concerns about how emerging financial technologies will be regulated. Furthermore, crypto mining can consume a lot of electricity, which has raised concerns about its environmental impact. Meanwhile, the development of DeFi and cryptocurrency payments has generated concerns about consumer safety, market volatility, and central banks' ability to implement monetary policy. What are governments doing about this? Many countries initially ignored cryptocurrencies, but their rapid rise and evolution, along with the rise of DeFi, has compelled regulators to begin drafting laws for the new sector, a lengthy process that might take years. Cryptocurrencies are regulated differently around the world, with some governments supporting them and others outright prohibiting them. Experts believe the difficulty for regulators is to come up with laws that limit traditional financial risks without suffocating innovation. What is a central bank digital currency? Many central banks, including the Federal Reserve of the United States, are considering developing their digital cash, known as central bank digital money, to assert sovereignty, CBDC. CBDC, according to proponents, promises the speed and other benefits of cryptocurrencies without the hazards. CBDC is being investigated by dozens of countries, which collectively account for more than 90% of the world economy. China is making rapid progress. In late 2019, it launched a digital yuan, which is being utilized for billions of dollars in transactions. There is allegedly disagreement among Fed officials in the United States about the necessity for a digital currency. Experts say CBDC's popularity grew in 2019 after Facebook announced it will launch its digital currency, Libra, which could provide a new payment alternative for its more than 2 billion users. Since then, the project has been renamed Diem and has been reduced back. Another driving force in China. Experts believe that a digital yuan would allow Beijing even more control over its economy and population, as well as jeopardize the dollar's standing as the preferred international reserve currency. Citizens having direct accounts with the central bank is one option to implement CBDC. This would provide governments additional tools to manage the economy. Stimulus payments and other benefits might be transferred directly to citizens, for example, and the central bank's stamp of approval would make CBDC a secure digital asset to retain. However, according to experts, its introduction could create additional concerns by centralizing a massive amount of power, data, and risk within a single bank, possibly jeopardizing privacy and cybersecurity. Some experts believe that CBDC's ability to eliminate commercial banks as intermediaries poses a risk because these banks play a crucial economic role in credit creation and allocation, i.e., making loans. If consumers choose to bank directly with the Fed, the central bank would have to either make consumer borrowing easier, which it may not be capable of, or find new ways to pump credit. Some experts believe that private, regulated digital currencies are superior to CBDC for these reasons. So that's it for today. What do you think of our video? Let us know your thoughts in the comments below. If you enjoyed this video and would like to hear more from us, please subscribe to our channel and turn on notifications before you go. Thank you so much for watching us.